Assalamu alaikum everyone. Today lecture is about financial statements and their types. What the financial statements are and what are the different types of financial statements and how they are prepared. Financial statements are also called financial reports. They provide the summarized information to the owners. There are major four financial statements: income statement, statement of owner's equity, balance sheet, and fourth one is statement of cash flows. We will discuss one by one. First of all, income statement. In income statement, we prepare statement which shows the profit and loss of the business. There are two only components which can be used to prepare a simple income statements. First component is the revenue, which the major source of revenue is sale, and all the operating expenses are deducted, excluded from the revenue. The result will be net income or loss. In case of trading or manufacturing business, another component, that is cost of goods sold, that can also be excluded from the total sale. If the total sale is 1 lakh and the cost of goods is 70,000, the remaining amount of 30,000, that will be gross profit. And from gross profit, operating expenses will be excluded and the result will be net income or net loss. In front slide, the simple income statement with two components: revenue earned or fee earned. The source of revenue is fees here, and all the operating expenses. Some examples are mentioned here: wages, rent, supplies, utilities, miscellaneous, etc. All these expenses, the total of all these expenses are excluded from the revenue, and the result is net income. So this one is the simple income statement which is prepared just to check the profit and loss of the business. Another statement, which is called statement of owner's equity, that is actually the portion of the balance sheet. The income statement result that may be in shape of profit or loss, net income or net profit, that is shifted to the or recorded to the statement of owner equity. So here you can see that the net income of 3,050, that is recorded here. The total investment by the owners at net income from the result of the income statement. If there is any withdrawal from the owner side for their personal use, which is normally called as termed as drawings, they are also excluded from the owner equity. And any additional investment by the owner that is added, the result will be the closing balance of the shareholders' equity or owner. Next one is the balance sheet. Balance sheet is prepared to check the total of assets and liabilities and owner equity. Asset sides are recorded on the left side, hand side of the balance sheet, while the liabilities and owner equity are recorded on the right hand side of the balance sheet. Liabilities and owner equity both are considered the sources of finance, while the assets are the resources of the business. And the total of assets must remain equal to the total of liabilities and owner's equity. When the balance sheet displays the liabilities and owner equity below the assets, this type of format is called the report form. While here we can see that assets are recorded on the left hand side and liabilities and owner equity are recorded on the right hand side. This type of format is called account form of the business. While if they are recorded in such a shape, in such a form, that shows the assets on a single page, and below that the total of assets, owner equity and liabilities are recorded. This type of format is called report form. Another financial statement is called the cash flow statement, which is basically prepared to check the closing balance of the cash. This statement shows the inflow and outflow of the cash in the business. There are two methods of to prepare the cash flow statement: direct method and indirect method. Here we can see that through direct method we can categorize all the activities of a business involving cash in three categories: operating activities, cash flow from investing activities, and cash flow from financing activities. Operating activities include the components recorded in the income statement: revenue earned and expenses, operating expenses. This section reports a summary of cash receipts and cash payments from operations. Means from operation of the business, what we have earned through sales revenue and how much amounts or cash have been paid for expenses. Are set up of activities which include cash that are recorded under the category of operating activities. While in balance sheet, we can see that there are three components: assets, liabilities, and owner equity. All these three components are recorded under the financing or investing activities. In investing activities, we can record the purchase and sale of fixed assets, permanent assets or fixed assets, long-term assets. If any cash received from the sale of asset or any cash paid for the purchase or acquisition of fixed asset, that will be recorded under the investing activity. While in financing activity, we can record only the liabilities and owner's equity. If cash received from owner's equity, investment by the owner, or from obtaining loan through any source like banks or other financial institutions, that will be recorded under financing activities. Or even withdrawal by the owners for their personal use or repayment of the loan to the banks or financial institution, that will be recorded under the financing activities. This one is the example of statement of cash flow, where we can check that all the transactions are recorded according to the categories of operating, financing, and investing. Keep in mind that in cash flow statement, credit transaction cannot be recorded. Thank you.